The recent takeover bid by Barrick for Newmont has created a divide in the mining community. We have a special panel for you here on day one of the PDAC. With me now is Amir Adnani. He is the CEO of GoldMining and UEC, and of course Rick Rule, CEO of Sprott U.S. Holdings. Welcome back to the show.
Pleasure to be on with you.
I always look forward to doing this panel every PDAC with you. You're two voices in the industry that people love hearing from. So I needed to get your thoughts on the mega merger. Big news coming out in our industry. First of all, when you first heard the news, thoughts that went through your mind. Were you shocked, Amir?
I was trying to get ready to get down to the BMO conference. I think we were all there. And so it made for a very entertaining morning. And so I think my feeling of being surprised and shocked, which I was immediately overtaken by having the CEOs of both companies available to speak and hear their thoughts. But definitely an element of shock.
And a lot of punches were being thrown, a lot of tension between the two companies, and you could really feel it in the air at the BMO conference. Rick, what are your thoughts? Is this a good thing for the mining industry?
I'm delighted by the broader trend of M&A in mining. Whether or not the bid was adequate is a very different question, but the industry needs more consolidation. It needs the consolidation for two reasons. The larger, more liquid companies trade at higher multiples, so their cost of capital goes down. In a capital-intensive business, that's critical. We need to reduce general and administrative expense throughout the industry. So administering more assets with lower general and administrative expense means higher returns to shareholders. But we also need to optimize assets. I'm delighted that you asked me the question with a young entrepreneur like Amir Adnani present. You could take an asset in Newmont or in Barrick that wasn't central to their focus, that they hadn't paid any attention to for 10 years, or a person that had spectacular intellectual capital but was redundant in those businesses, and put them into Amir's company. And Amir, by focusing on that person, mentoring that person, by focusing on the asset, by developing the asset, could double or triple or quadruple the value of his companies using assets that were totally redundant to Newmont or Barrick. This is a wonderful thing at every level.
Okay, so a positive in terms of finding new deposits.
Positive in the sense that assets that didn't matter to those big companies, or people who didn't matter, that could be grown better by smaller people who could focus on them, at the same time that it's better for the big companies too. Everybody wins, with the exception of the people who become made redundant.
Right. What about for Goldcorp? What does it mean to them?
That'll be more challenging, but Goldcorp also will benefit ultimately if this merger mania goes on. Reducing G&A and increasing capital efficiency is the single most important challenge that the gold mining industry faces. We hate to admit that as an industry over 40 years, we have destroyed rather than generated capital. And our biggest sin is general and administrative expense relative to free cash generation.
I interviewed Pierre Lassonde, obviously mining legend, at the BMO conference, and he said he's never seen anything like this in his career. What he called this take under bid for Newmont. Amir, do you agree with what Rick was saying, that overall this is a positive for industry down the line?
Just going back to, I think, the main premise of what Rick is saying in terms of really increasing and optimizing return on capital and really creating companies that are managed from a standpoint of generating better shareholder returns. I can't help to think that reducing G&A, reducing the administrative costs, I mean, that was a big argument that Barrick made when they did the deal with Randgold, which wasn't that long ago, was the NPV associated with G&A cost savings of doing those two deals was the equivalent of building a new mine. It was massive, and so I think we have big, and I think the other point that Rick made, which is something that's on my mind a lot as someone involved in building these companies, is we have structural changes in capital markets and capital flows. So much more capital is going to these passive funds, the ETFs. And to get a bigger chunk of that capital flow, you need to be bigger. You need to have bigger size in terms of market capitalization. And to Rick's point, that drives a lower cost of capital. The bigger you are and the better multiples you trade at. So look, I think we get it. And ultimately, whether the premium is adequate or not, I think that's something for Newmont shareholders to decide and have a say in. But it's fascinating. You know, we haven't seen the gold price above $1,400 for 6 years. These early signs of M&A are perhaps also telling us something about where we are in the cycle.
And I want to get to that in a second, but I had one analyst on, and just to your point, Amir, that said that this consolidation is just a way for miners to stay relevant to institutional investors.
I think that's partly true. I think the way they become relevant to institutional investors is to become more liquid, but also to become more efficient. Cutting G&A is critical. It's interesting, by the way, that you mentioned Pierre Lassonde. Pierre Lassonde is the embodiment of corporate efficiency. Management, general, and administrative expense at Franco-Nevada is 12 basis points. He has the lowest general and administrative expense in the industry by a country mile, which is why he trades at the highest multiple. I can understand as a Newmont shareholder that he would be offended by a take under, but he is an example of how you run a company efficiently.
And now the other side of the equation, and you mentioned the premium part, you know, Rob McEwen's saying to me that he wants to see more deals where premiums aren't involved. You're nodding with that. You agree with that?
Well, it depends on whether or not I'm a shareholder.
Right.
If I'm a shareholder, I want Rob to pay a very healthy premium. If not, I'm agnostic.
Let's get to sentiment in the space now. We've had a good start to the year. There is talk of always the PDAC curse that after March, we know what happens to the metals. Is it, you know, we don't know if there's truth behind that theory or not, but do you feel good about where we are right now in the space, Amir?
Well, it's funny to talk about the PDAC curse because the last time we had, just speaking about gold for a second, if you think back to PDAC 2016, we had a heck of a run in gold and gold equities actually commencing after PDAC. And so these things, I think we need to kind of get it out of our head that the PDAC for some reason is a bad thing. And a lot of the issues that drove the post-PDAC rally in gold in 2016 are in play right now. They had to do with Brexit, which is still unresolved. It had to do with uncertainties around the political landscape, which is heightening everywhere in the world, by the day and by the month. Of course, gold's had an interesting start to the year with the run up to 1350 and back. But I think the sentiment, to me, it feels much better right now on gold, and uranium's a different story.
We're gonna talk uranium in a bit. Rick, thoughts on gold? Do you like it right now? Do you feel good about it?
Yeah, with the caveat that my horizons are longer than most of your listeners' horizons. Something that happens over a week or 3 months or something doesn't matter much to me. I've made my money over years. I feel good about physical gold because I'm nervous about the US dollar. I feel good about some of the gold stocks because the companies that are represented by the shares are performing better. Right. They're doing a better job. They're doing better capital allocation. So I feel good in both regards.
Well, let's talk about the dollar and the landscape in the US because we will be entering, or we have entered, the third year of the presidency. Usually this is the year where they want to show that the economy is doing great. They have a lot to prove ahead of the next election. So are we not preparing ourselves for a stronger US economy, which would not necessarily bode well for gold? Or the appearance of such?
With the caveat that I'm a credit analyst, I'm not an economist. I'm amazed by the resilience of the US economy. Trade wars, as an example, make everyone poorer. The fact that we've survived that maybe has to do with the tax cut. I'm not unconvinced that adding liquidity to the economy masks the fact that with the debt, we're less solvent than we used to be. It seems that people confuse solvency with liquidity. They're very, very different words, so I'm nervous about that. At the same time, though, where we still have such an innovative society in the United States, that you get 6 pimply-faced kids taking over a garage in Sunnyvale, and out pops Google. I mean, it's still an amazing place. I think the strength that you see in the US dollar may have more to do with the weakness of competing currencies. Bringing it back to gold, though, twice before in my career, I've seen gold strong while the US dollar was strong. And in both of those circumstances, the US dollar rolled over and gold did very well. Is past prologue? I don't know, but I'm encouraged by the fact that gold does well simultaneously with a strong US dollar.
Amir?
Absolutely resilient performance here in the US and the economic data. I'm concerned about China. 2008, debt to GDP in China was about 150%. Xi Jinping came in trying to really get debt under control. It's about 250% right now to GDP. So I think the issue becomes also a relative game, like Rick alluded to. We continue to see weakness in the world's second biggest economy, and other currency are weaker relative to the US. USD could be strong, but again, it's this question that we're seeing a strong gold price vis-a-vis very strong US dollar.
But many investors watching want to get back to those highs we saw in 2011. They want that 1900 plus gold. What's missing from the equation today? What's different than 20?
Fear. Their response was conditioned by 2008. They got really, truly scared. And the fact that gold ran validated their fears. There's no fear in our economy about anything. Everybody says buy the dip. The Fed stick-handled, to use Canadian parlance, the problem. There's no fear. If you introduce fear into this economy, you'll see a very different gold price very rapidly.
But you would think last year would have been a good fear trade, right? With talk of nuclear war and trade wars, and I mean there was no shortage of fear factors.
Nothing like 2008.
Right, on so it would really need a market crash.
A liquidity crunch would do nicely. I don't want one, by the way.
It's probably, I would say it's a 1-2 punch. The fear would then drive a different kind of policy by the Fed. I mean, I think we had in that period where you see this run up to 1900, we had Helicopter Ben, former chair of the Fed, who was printing like crazy and quantitative easing, and that debasement of the currency was something that they were aggressively driving that we haven't had obviously over the last few years. But it's the fact that despite the strength in the US dollar and US economy, gold has actually held in at the levels that it did last year and even so far this year is a very positive sign, very positive indicator for gold.
Shifting gears here to talk uranium, obviously Amir, as the head of UEC, we're going to be talking about a little bit more detail in our interview. Any thoughts on uranium? There was so much hype around it last year. Have we come down a bit from that?
Well, I just want to suggest that it wasn't necessarily hype last year. I think last year we saw a very constructive sort of rise in the price from $21 per pound to about $29 per pound, driven by supply cuts, driven by a nice fundamental shift on the supply-demand dynamics. The person who should stay nameless, because Rick doesn't like it when I evoke Trump, has a lot to do with, I think, the pause that we're seeing right now in the uranium price. Certain decisions that the US government needs to make in the coming months are the reason why the price is kind of taking a breather. But we will have in 2019 a projected supply deficit in the uranium market. This is the first time there's a supply deficit since 2010, 2011.
So are the stars lined up for uranium, lining up?
They absolutely are. Again, it's a question of perspective. Most speculators want to believe in the tooth fairy. They're nervous about having a position over a long weekend. It could take 2 years or 3 years for this to work out. The last time that I was in the uranium space, I ended up coming 5 years early, which is a different way mostly of saying that you're wrong. But the truth is that I made so much money that the wait didn't matter. If investors have the courage of their convictions, if they're willing to buy a commodity that's essential for the way that we live, that's selling at less than the cost of production, This is the simplest investment thesis of all times. People get in their own way because they impose time constraints that are irrelevant. If people have the patience to suggest that they might have to own something for 2 years, they are staring at tenfold gains in some of the uranium juniors. This is a simple equation.
Of course, people love chasing what's hot, right? We saw that with the cryptos. Palladium's having a moment. Now everyone's asking me, how do I get into palladium? But there's dangers there.
Yeah, I guess it was Einstein that famously said, after hydrogen, stupidity is the most prevalent element in the universe. It is amazing to me that people don't understand the uranium thesis.
All right, well, wrapping up here, gentlemen, lots of good thoughts. Any final thoughts for investors watching? Words of advice, words of wisdom?
Sure, common sense. Investing is all about common sense.
Well said. Amir?
Common sense and patience.
Common sense and patience. You heard it here first. Thank you for watching. We'll have much more for you on Kitco.com. Thank you, Amir. Thank you.